Why is crypto crashing?
The crypto market continuing to crash.
Crypto is crashing.
The crypto market is in free fall today.
We are seeing a historic collapse in the crypto space.
Look, I've been there, watching my portfolio drop 30% in just one single day, refreshing Twitter every 5 minutes trying to figure out what the hell just happened. And honestly, most of the explanation out there are just pure garbage. Walls are moving. It's manipulation, or Elon tweeted something. It's not about that. There is a truth nobody wants to tell you. Crypto doesn't crash randomly. There are some actual predictable patterns behind these moves, and once you understand them, you stop panicking and start profiting. Today, I'm going to break down the real reasons crypto crashes and, more importantly, how to protect yourself when it happens. Let's get into it. Number 1, the macro picture. First thing you need to understand is crypto doesn't exist in a vacuum. When people ask me, why did Bitcoin drop today? My first question is always, what did the Fed do? Interest rates sound boring, but here's the deal. When the Federal Reserve raises interest rates, borrowing money becomes expensive. Investors pull money out of risky assets. And guess what is considered the riskiest one? Yes, right, crypto. It is the same when inflation data comes out hot, or when there is a banking crisis, or when the stock market tanks. In this situation, money flows out of the crypto and into safe stuff like bonds or cash. This is why you'll often see Bitcoin drop on the same day the S&P 500 drops. They are more connected than most people realize. So before you blame some random whales, just check what's happening in traditional markets first. Now let's talk about the second big one, regulation. Every time the SEC announces a lawsuit, or China bans crypto for the 37th time, or some senator processes a new bill, the market reacts. Sometimes it overreacts. Remember when the SEC sued Binance and Coinbase back to back? In that moment, Bitcoin dropped like 10% in a week. But here is what is interesting. A few months later, we were hitting new highs. The market has a short memory. Here's why. Regulatory FUD creates panic selling, but it rarely changes the long-term picture. The key is knowing the difference between actual existential threats and the temporary noise. Here's my rule. If the news affects the fundamental of crypto, like making it illegal to hold, that's serious. But if not, or if it's just another lawsuit, it doesn't matter. It's usually a buying opportunity. Number 3, whales movements. Let's address the elephant in the room, whales. Large holders can move markets. When a wallet holding 100 Bitcoins suddenly transferred to an exchange, people start to freak out. They think they are about to dump. But here is what most people get wrong. Whale movements are symptoms, not causes. Big players don't just wake up and decide to sell. They are usually reacting to the same micro forces I just mentioned. They just have more money to move. Also, not every exchange transfer is a sell signal. Sometimes whales are just moving funds between wallets or depositing for other reasons entirely. The tools to track whale movements are useful, but don't let them make you paranoid. Focus on why the whales might be moving, not just that they are moving. Number 4 is leverage liquidation. This one is huge and most people just completely ignore it. Crypto markets are filled with leverage traders. It means people borrowing money to bet on price movements. When the market goes their way, they make a fortune. But when it doesn't, liquidation cascade. Here is how it works. Let's say Bitcoin dropped 5%. That triggers liquidation for traders who were 10x long. Those forced sales push the price down another 3%. That triggers more liquidation. Rinse and repeat. This is why crypto crashes can feel so violent. A small move snowball into a massive one because of all the leverage in the system. You can actually track this on site like Coinglass. When you see $1 billion in liquidation in only 24 hours, you know the leverage was the accelerant. Finally, let's talk about something sounds soft, but it's incredibly powerful. Market sentiment. Crypto runs on vibes more than any other market. When everyone is greedy, prices go up. When everyone is fearful, prices crash. It's that simple. You can track this index too. The fear and greed index literally tracks this. When it hits extreme greed, expect a correction. When it hits extreme fear, historically, it's been a good time to buy. But here is the psychological trap. When you are in the moment, it never feels like the bottom. Every crash feels like the crash that it will take everything to zero. That is why you need a plan before the crash happens. Okay, how to protect yourself? Here's my playbook. Number 1, never invest more than you can afford to lose. I know you've heard this a million times, but seriously, if a 50% drop would ruin your life, you are overexposed. Number 2, have a plan before the crash. Decide in advance. At what price do I buy more? At what price do I sell? Write it down. Because when prices are crashing, your emotions will betray you. Make sure to write it down. Number 3, do not use leverage unless you really know what you are doing. Because most people don't. And those liquidation cascades. You remember those liquidation I just mentioned? You do not want to be part of them. Number 4, zoom out. Every crash in crypto history, including the 80% drop, has eventually recovered. If you are investing for a long term, a short-term volatility is just normal, it's just noise. The best protection against crashes is not being fully invested at the top. Crypto will always be volatile. That is the trade-off for the potential upside. But volatile doesn't mean random. Now you understand what actually moves this market. If this video helped you, drop a like and subscribe. My name is Bella, and see you in the next video.